There is no need to fear news events anymore. In fact, this strategy by Mario Singh is one where you can embrace news events thanks to his easy to follow fundamental strategy, Balk the Talk. In this video, I'm going to give you a complete guide on this strategy from the background, the rules, and even trade examples for you to follow. And that means by the end of this short video, you will have this strategy locked and loaded, ready to use whenever you wish. Let's dive in. Balk the Talk is one of the strategies from Mario Singh's book, 17 Proven Currency Strategies. There is no doubt about it, economics can be tough and it can be demotivating, and for a lot of people, it's quite boring. But thankfully, it doesn't have to be this way. This is a purely fundamental strategy which plays on one key word, fear. Fear is a greater driving force than pleasure, which is why this strategy is based only on negative news. Mario Singh believes bad news is one of the best ways you can become profitable, and I'm about to show you how. You'll be really pleased to know that trading Balk the Talk is very easy. You will see the rules in front of you right now. Now, we can use any major forex pair. That's basically any dollar related pairs. We just use the one that has the affected currency in the pair. So for example, if we're looking at Canadian dollar news, we would trade USD CAD and so on. We either use the 15-minute or the 30-minute chart to determine our entries because the news is usually released in 15-minute intervals. For example, 8 AM, 9:15 AM, 10:30, 11:45 and so on. There are no indicators for this strategy. In fact, there is no technical analysis at all. And the stop loss and take profit is always fixed. It's a 20 pip stop loss for a 40 pip gain. No more, no less. On a 3% risk as suggested, therefore, this strategy has a profit potential of 6% per trade. With this also being a fundamental strategy, it can be executed in any market condition, ranging or trending. The important bit, the rules. How do we actually take trades? Well, trades are taken by comparing the forecasted figures of news events with the actual figures. It takes advantage, remember, of negative news. It plays on the emotion of fear. Therefore, we need to work out the difference between the actual figure and the forecasted figure of a news event. And the actual figure must be at least 20% lower than the forecast. There are two exceptions to this, PMI and interest rates. For interest rates, the deviation has to be more than 20 basis points, which is 0.2%. And for PMI, the deviation has to be more than 50 basis points, which is 0.5%. Look, I know maths can be boring, and you may be thinking, well, how do I even calculate it if it's 20%? Let me show you how. It's really easy. All we have to do is watch out for news events and then apply this formula which is on your screens right now. That formula is, we take the value it's fallen by, we divide it by the original value, which is the forecasted value, and we multiply it by 100. There you have your percentage change, and we're looking for a minus 20% minimum. For example, let's say CPI figures just came out in the UK. The forecasted figure was 3.5%, but the actual figure was 2.8%. Well, the percentage change is the value it's fallen by, which is minus 0.7, divided by the forecasted figure of 3.5, multiplied by 100, and there we get minus 20%. We've got minus 20%, we would now enter short GBP USD with a 20 pip stop loss and a 40 pip take profit. So then let's take a look at an example now. So the first thing we want to do is make sure we've got our economic calendars, and you can see I'm using the How to Trade economic calendar, and if you want access to that, it's really, really simple. Head over to the website, hover over resources. If you click on trading tools, that will take you to a web page where you will see clearly view economic calendar. Of course, you can use any economic calendar for this to work. So February the 14th is currently 7 o'clock in the morning, and we've got our consumer price index data out of the UK. And you can see that the estimated figure was minus 0.3, the actual figure was minus 0.6. And then we work out the calculation for the percentage difference, which is popping up on your screen now. So the difference between those two values is obviously 0.3. We divide that by the minus 0.3 and times that by 100, and that gives us a 100% decrease, which is obviously larger than the minus 20% needed. So we head over to our pound versus US dollar charts here, and I'm at that time of when that news event come out. Now, we want to enter as close as we can to the opening of the next candle. Now you can see what happens here is obviously we get a huge slump lower. This is a 30-minute chart. So if, for example, it took you, say, 30 seconds to calculate that, you may not have got in exactly at the opening of the candle. So we give ourselves a bit of leeway there, just roughly. We always set our stop loss to 20 pips and our take profit is always 40. Now you can actually see that if we'd have done that, the trade goes on to hit take profit and falls even further. So let's say, for example, we couldn't quite get in at the opening of that candle. Well, the move actually fell nearly 60 pips. So even if our entry was all the way down here with a stop loss of 20 pips, and we entered here, you can see that the trade still went down and hit our take profit area of 40 pips. And that's a great example of how we can trade it. You know, the truly amazing thing about this strategy is that you don't need anything on your charts. Just simply work out the difference in the actual and forecasted figures during news events. And if it's at least a 20% difference to the downside, then away you go. All of the rules of the strategy and breakdown of examples are in the PDFs below the video, together with a link to Mario Singh's book. You can also join us in our Trade Together live streams every single day and watch the coaching team put this strategy into action. See you soon.